There's a very common approach to central bank announcements in Forex. A rate decision comes out, traders jump in. They expect the currency to move in the obvious direction, and sometimes it does, but a lot of the time it doesn't. Or it moves the right way for 10 minutes and then reverses completely. And when that happens, most traders assume they did something wrong. Maybe their timing was off. Maybe they misread the chart. Maybe they just got unlucky. But in many cases, the problem isn't execution, it's the underlying idea itself. The belief that you can trade central bank announcements by reacting to the headline, rate hike means buy, rate cut means sell, is one of the most widespread misunderstandings in retail Forex. It looks logical, it feels logical, and it's taught as fact in a lot of beginner content. The issue isn't that central banks don't move currencies. They absolutely do. The issue is the time frame, the mechanism, and what moving actually means at the level where it matters. In this video, I want to walk through why the reaction-based approach to central bank events so often falls apart, and how to think about central bank actions in a way that actually holds up over time. The logic behind trading central bank announcements directly is pretty straightforward. Central banks raise interest rates when an economy is strong. Higher rates make a currency more attractive to outside investors because they can earn better returns. So, when a central bank hikes rates, the currency should strengthen. When a central bank cuts, returns go down, and the currency should follow. And that reasoning is not wrong. It's actually a real mechanism. Higher rates do attract capital. Lower rates can reduce a currency's appeal. The relationship between interest rates and currency values is genuinely there. So traders watch the economic calendar. They know when the Federal Reserve is meeting, when the European Central Bank is scheduled, and when the Bank of Japan will speak. They form a view on what the decision will be, and when the announcement hits, they try to position themselves to catch the move. This feels like smart, informed trading. You're not guessing at random. You're using fundamental information, the kind of information that actually drives markets. You're responding to real news about real policy. And the appeal here is completely understandable. You're not using some obscure indicator. You're watching the actual institutions that set monetary policy and trying to trade in the same direction as their decisions. And that sounds exactly like what a serious trader should be doing. And that's what makes this so tricky. The logic is built on a real foundation. The breakdown isn't in the idea itself. It's in how and when that idea is being applied. Here's where that approach runs into trouble. By the time a central bank announcement is made, the market has already been thinking about it for weeks, sometimes months. Traders, institutions, economists, and analysts have all been reading the data, watching the speeches, and forming views on what the central bank is likely to do. That process of forming views and acting on them is already reflected in price before the announcement ever happens. The market doesn't wait for confirmation. It prices in probability. If a 90% rate hike is expected going into a meeting, the currency has likely already adjusted to that expectation. The hike, when it arrives, isn't news to anyone. This is the core problem with reaction-based trading around announcements. Price often moves on expectation, not on the event itself. So when the event confirms what was already expected, there's nothing new to price in. The move either doesn't happen, or worse, you get a reversal as traders who bought in advance take their profits. This is sometimes called the buy the rumor and sell the news, and it's not a quirk or an anomaly. It's a natural consequence of how forward-looking markets work. There's another layer too. Even when a decision surprises the market, the immediate reaction can be violent, disorderly, and short-lived. Spreads widen. Price spikes in one direction and then snaps back. And if you're trying to catch that move, you're competing against automated systems executing in milliseconds. And for most traders, that's not a game worth playing. The breakdown in short is this. The logic connects rate decisions to currency direction, and that connection is real, but the timing assumed by the tactic is almost completely wrong. The right way to think about central bank actions is not as events to trade. It's the inputs that shape the longer-term background for currency direction. When I look at a central bank, what I'm really asking is, what cycle is the bank in right now? Are they tightening, easing, or holding? How committed do they seem to that path? And how does that compare to what other major central banks are doing? The last part is important. Forex is always a comparison. When one central bank is actively raising rates and another is cutting or holding, that difference, that divergence, can create sustained directional pressure on a currency pair over months. That's a very different thing from trying to catch a 10-minute spike on announcement day. I also pay attention to tone, not just decisions. After a rate decision, there's usually a statement and a press conference. The language in those communications signals where the bank's headed is at. Words like patient, gradual, or data dependent carry meaning. They tell you how confident the bank is, whether they're open to changing course, and roughly what they expect to do next. This kind of reading doesn't give you a trade for today. What it gives you is a clear picture of the macro environment your trades are sitting inside. And that picture can be extremely valuable when you're holding a position for weeks or months. The shift in thinking is this. Stop asking what happens to the currency when this announcement comes out, and start asking, what does the central bank's current stance tell me about the direction of the currency over the coming months? If reaction based around trading central bank events doesn't hold up well in practice, why does it stay so popular? Well, part of it is visibility. Central bank meeting dates are on every economic calendar, and they're treated as major events by the financial media. When a rate decision comes out, news channels cover it, analysts react in real time, and you can watch price move on a chart as it happens. It looks like information you can act on immediately. And part of it is also the occasional win. Sometimes the reaction trade works exactly as expected. The rate hike happens, the currency jumps, and someone who bought right before the announcement makes a clean profit. That experience is memorable. It confirms the logic, and it doesn't take many wins like that to build a belief that the approach is sound, even if the overall track record doesn't support it. There's also the way that this content gets taught. Much beginner Forex education explains the currency rate relationship without addressing the underlying layer of expectations. You learn that higher rates strengthen currencies. Look at the calendar and draw a natural conclusion. That missing piece, that markets price and expectations before events occur, isn't always taught alongside the basic relationship. So traders apply a rule that's half complete. None of this reflects badly on the traders using the approach. It reflects the way information tends to be presented and reinforced. The logic that gets shared most widely is the simplified version, and simplified versions of market dynamics tend to leave out the parts that would complicate the picture. For position trading, central bank analysis belongs at the macro level of your thinking, not at the execution level. What that means in practice is this. When I'm looking at a currency pair and considering a trade with a multi-week or multi-month horizon, I want to understand the monetary policy backdrop. Is one central bank in a tightening cycle while the other one is on hold? Has one recently turned more cautious in its communication? Is there a clear divergence in policy direction between the two countries? That context matters because it can tell you whether a trend has real underlying support or whether it's moving against the macro trend. A trade that aligns with a clear policy divergence has a different character than one that doesn't, not because it's guaranteed to work, but because the forces behind it are more durable. The way I use central bank information is as a filter, not a trigger. It doesn't tell me when to enter a trade. It tells me whether the broader backdrop supports the direction I'm considering. There's a much more stable and reliable use of the information. It also requires patience. Policy cycles unfold slowly, and divergences build over months. The reward for tracking this correctly isn't a fast move on announcement day. It's a clear read on why a multi-week trend might have staying power, and that's the kind of edge that's worth building. Central banks do move currencies, that part is true, but they move them through cycles, through sustained policy differences, and through shifts in market expectations, not through announcements that you can react to in the moment. When I think about how to use this kind of analysis, I keep coming back to the same idea. The goal is context, not signals. Understanding what a central bank is doing gives you a clear picture of the environment your trades are operating in, and that's genuinely useful. Trying to trade the announcement itself, that's where the logic starts to break down. The shift I'm describing isn't complicated, but it does require slowing down. It means watching policy cycles instead of calendars. It means reading tone instead of headlines. And it means accepting that the edge here isn't speed, it's comprehension. That's a harder thing to sell than a simple rule, but it's a more honest description of how this actually works. The complete guide behind this video, central bank actions in Forex trading, and introduction is available on the Position Forex website and linked in the description. It covers the specific tools central banks use, how communication shapes market expectations, and how to think about risk amid policy-driven volatility. If this video shifted how you think about central bank analysis, The article will help you build that understanding into a complete framework. And until next time, best to your trading.